Good morning and welcome to the PERSIMMON PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab that's situated on the top right corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CFO Andrew Duxbury. Good morning to you, sir.
Good morning, thank you, and morning everybody. Thank you for joining today's call. So we're really pleased with our 2024 results. We've achieved a return to growth after reductions in 2023, and I'm really confident that we're well positioned for more to come. So I'm going to start this morning with some of the key highlights from our results. So as you can see on the slide, we've grown underlying PBT by 10% to £395 million. We've delivered a 7% growth in completions to 10,664. Our sales rate in 2024 of 0.7 is up 21% from last year's 0.58. We've grown our owned land bank by 4% to over 69,000 plots. And the total number of plots in our short-term land bank is now over 82,000, and that gives us excellent visibility for the year ahead. Build quality and customer service is at a record high, with the HBF 8-week score at 96%. Our current forward order book is up 12% at £1.7 billion, and within that, the private order book is up 27%. And finally, underlying earnings per share for 2024 of 92.1 pence is up 12%. So in combination, everybody, these are excellent results that are delivered through the hard work of my colleagues up and down the country. And really importantly, this improved financial performance was against a backdrop of a sector that went backwards in 2024. So that demonstrates the tangible benefits of our own business improvements that we've put in place over the last few years. And it's these improvements that mean we're set for further growth in 2025, as I'll come back to later on in the presentation. But first, just to give you a little bit more colour on the 2024 performance. So this slide sets out the volume split, and you can see of the total new homes delivered in 2024, 9,075 were private, and that's 18% higher than the previous year, driven by increased sales rate, increased number of sales outlets, and bulk investor sales. We finished the year with 270 outlets. That's 5% more than we started the year with. And bear in mind that outlets in the sector as a whole shrank by 5% across the same period. 31% of our private completions were to first-time buyers. That's a very important market for us as well. You can see on the slide that partnerships output fell. That was 15% of total completions, but from a particularly high point in 2023. And typically, I'd expect that to be 15 to 20% of completions going forwards. Private average selling price increased a small amount, as you can see, and overall pricing has been robust, particularly through the second half of last year. Importantly, our product remains affordable, with Persimmon Homes' average selling price 20% lower than the average new build across the UK, and with 60% of our completions below £300,000. Across the year, average incentives on completions were around 4.5%, but off slightly stronger pricing. And our blended average selling price was up 5%, which in combination with the increased volumes led to revenues increasing by 13%. This slide shows how that increase in revenue led to a £50 million increase in underlying operating profit and an increase in our underlying operating margin to 14.1%. You can see on the slide the positive effect of the increased volumes, the increased average selling price, and the positive mix moving more towards private units. The movement in the cost line is small, and we continue to be very, very focused on commercial disciplines across the business. Net operating expenses increased by £11.6 million. That was a 7% increase, lower than the 13% increase in revenues, showing improved overhead efficiency. And it's worth remembering, of course, that's on an underlying basis. Within our exceptional costs, we included a £2 million adjustment for our building safety remediation provisions, and it's building safety remediation that I'd just like to cover now briefly. So this is an important topic, and the most important thing here, everybody, is that we are getting on with our remediation work, getting on with our obligations, and we're making good progress. We are on site or complete over 70% of known developments or 80% of known buildings, and just one additional development came into our programme last year. And importantly, we have assessed all known developments. So this is a complete list of our developments within our scope. During the year, we spent £58 million, and that brings our total spend on remediation works to around £120 million. And I expect us to spend another £100 million this calendar year. So the provision at 31st December 2024 was £235 million, and you can see that the bulk of the remaining spend is going to be spent over the course of the next 2 years or so. Getting on with this spend is the right thing for us to do, and it will also create free cash and capital allocation opportunities for us in the future, which I'll come back to shortly. Our capital allocation opportunities also include investment in future growth, and that's the basis of that is our strong balance sheet. So in the year, our net assets increased 2.5%, and within this we reported net cash at December of £259 million. And even taken together with our land creditors, that means our gearing at the end of December was less than 5%. So we said this time last year that our cash would reduce in 2024, and you can see on the slide how the cash changed through the year. The year-end position is still very, very strong, even though we've invested substantially in the future growth of the business. We've invested over £1.5 billion in land over the last 3 years. So just working across the bridge there, you can see cash inflow from operations was £420 million. The net cash flow into new land, so after land utilisation and the movement in land creditors, was £113 million, and that is about investing in future growth. WIP and other working capital movements of £61 million includes an increase in our part exchange holdings, but again, we're very focused on turning those PX holdings into cash. We spent £102 million on interest and tax, and so before our building safety remediation works and before dividends, we had a net cash generation of £89 million, and that would have been a net cash inflow of £202 million before the net investment into new land. So what that demonstrates is that our model is cash generative and sustainable, even at the bottom of the housing cycle where we are at the moment, and will start to generate strong cash as we grow the business. So let me now move on to capital allocation. The structure of our capital allocation policy is set out on the slide. So we will maintain our strong balance sheet, we'll keep low leverage through the cycle. And alongside this, we'll prioritise dealing with the building safety remediation works, which I talked about earlier. And for context, that building safety remediation work, that £58 million, that equated to around 18 pence per share in 2024. Secondly, we'll continue to invest to grow our number of outlets, driving our organic growth opportunities. And we've deliberately continued to invest in our capabilities and to invest in land at the bottom of the cycle, over £1.5 billion in the last 3 years. This has reduced our current cash position, but it's providing us a platform for growth, as I'll come on to shortly. And we'll continue to pay a sustainable dividend well covered by profits through the cycle. So to be sustainable, we won't over-distribute. We need to continue to invest in growth. And given the strong performance in 2024 and the good outlook, we've retained our final dividend of 40p, bringing a total dividend for the year to 60p, with underlying dividend cover increasing from 1.37 times to 1.54 times. And as we deliver our growth plans and we progress our fire safety remediation works, I'm very confident that we'll be able to grow our dividend as a result. So what I'd like to do now is spend a little bit more time talking through our strategy and our growth plans. So I will spend a few minutes on this single slide. So it is really important, it's very good to see the business growing again in 2024. And the strategy which I'm about to walk you through here gives us optimism that we can continue to grow into the future. So firstly, our strong balance sheet and improved planning performance is helping to grow our pipeline of new sales outlets. So in the last 3 years, we spent £1.5 billion on land. We've utilised about £1 billion of land. And that's in a period where land prices have been softer than previously. In 2024, we increased our outlets to 270. That was up 5%, even though the market as a whole reduced outlets by 5%. In 2024, we achieved planning permission on over 13,000 plots. That's 120% of last year's delivery, meaning that we're in a better position to grow than we came into last year with. And our planning consents were 20% higher than in 2023. And that shows the benefit of our own improved approach to planning and a more supportive policy environment. Secondly, our record quality and customer service scores are enhancing our reputation, and that is helping us to sell more homes. So in the year, our HBF score reached a record 96%. And over the last 5 years, we've moved from being bottom in the peer group to being third amongst our industry peers. Our reportable items, which is a measure of build quality, improved again in the year, and we're now 60% better than we were in 2019. Thirdly, our investment in sales and marketing. That is also generating more inquiries and is improving our sales rates. So the customer consideration of the Persimmon brand has increased 26% in the last 2 years, and customers' trust in the Persimmon brand has increased 14% over the same period. We've invested in new sales teams, we've invested in new sales systems to generate more inquiries. And website inquiries this year so far are up 20%. And that's building on consistent year-on-year improvements since 2022. And we're continuing to invest here. For example, in a new interactive customer website and in new marketing cloud systems to help target and track individual customers through the sales journey. Last year's sales rate was 21% higher than 2023. And so far, the sales rate is up again this year. So fourthly on the list, our 3 diversified brands are providing us new opportunities to drive volume, to drive margins, and drive improved return on capital. So Persimmon Homes is very well positioned. That's with simple, standardized house types that are quick to build. Charles Church, our premium product, is a clearly distinct product. It's positioned for cost-conscious customers who are prepared to pay a premium for a higher value product. And this is delivering margins over 4 percentage points higher than the typical Persimmon house. And we think we can double the volume of Charles Church products over the next few years, following a brand relaunch that we completed at the beginning of last week. And our third brand, Westbury, is ideally placed for the Section 106 and the growing build-to-rent markets. That build-to-rent market has doubled to £5 billion per annum over the last 5 years, and around half of the delivery in 2024 was for single-family accommodation outside of city centres, exactly the kind of product that Persimmon produces. So we'll continue to engage with the build-to-rent sector to drive volumes and drive increasing returns. Fifthly, our unique vertical integration model provides efficiency and scale opportunities for us. So in 2024, we self-manufactured over half the bricks that we used and over 80% of the roof tiles that we used last year. And that provides us with security of supply, it protects us from cost inflation, and it provides us real cost efficiency opportunities. Used alongside our own timber frame kits, we can save up to £5,500 per plot, supporting our margin improvement plans. And we're currently investing in upgrading and automating our timber frame factory. And in due course, we've got planning permission and we'll build a second factory, doubling our capacity of timber frame production. Alongside this, we're also investing in a new facade product to use with our timber frame houses, allowing us to construct the superstructure, so from foundations up to roof, including that tiled roof, within 5 days. Whereas at the moment on a typical construction site, that would take nearer 12 weeks. So a huge time and cost saving for us. And all the products that we would use in that 5-day build could be manufactured within our own factories, giving us that security of supply and cost efficiency, as well as increased return on capital. And finally, whilst none of us can predict the macroeconomic dynamics, the government's pro-house building agenda is very welcome, and their planning reforms could provide a tailwind, adding further outlet growth given our strong strategic land bank. So strategic land was the source of 42% of completions in 2024, and we continue to replenish it. So we currently have 70,000 plots in that strategic land bank with excellent margins, and some of these we will be able to accelerate to production because of the planning reforms announced by the government. So far we've identified 38 sites, 7,500 plots, and we're continuing to assess what the new planning policies mean for our portfolio going forwards. And you can see on this slide how the areas that I've just been talking about will allow us to grow our margins back in the medium term to 20%, assuming stable market conditions. It's important to say this is not going to be a straight line progression. There's regulatory changes, including the building safety levy and future home standards that will come into play, and they will dampen the margin growth in the short term until they're fully factored into land prices. And beyond this, of course, our margin progression will be accelerated or held back by wider macroeconomic drivers. But we're confident of the elements that we're controlling. You can see on the slide there, the volume impact, Charles Church, vertical integration, and the land buying, the new land coming through post the inflation spike of 2022. Our operating margin is already higher than our direct peers, and we've got a clear plan for margin progression and increased capital return as a result. So to summarize, our strategy delivered a turning point in 2024, and 2025 has started so far very well. So we believe that this is just a summary of the 2025 start, and you can see the improved forward sales book on the slide. So we believe that we're well placed to deliver growth in 2025 to over 11,000 units, and our private order book is already 27% higher than last year. That includes a 23% increase in the number of homes sold, and ASPs up 3%. You can see from the slide that private sales in the first 9 weeks of the year are very good, including books sales. Our sales rate is up 19% compared to last year at 179 sales a week. And excluding bulk sales, it's up 8% to 158 sales per week. And incentives this year so far are down a little bit, even though pricing is stronger. So putting all of that together, as I say, this is a very good positive start to the year. So to summarise, although there will be bumps in the road, the building safety levy, future home standards, and of course the volatile macroeconomic and geopolitical risks that we're all aware of, we are optimistic about our growth prospects over the medium term. We've got a strong land bank and a growing pipeline of sales outlets. We have 3 distinct brands, each well positioned in their respective markets. We're delivering record build quality and record customer service. Our deepening investment in vertical integration could drive a step change in volume at cost-efficient rates, and our commitment to a strong balance sheet is absolute and resolute. Importantly, our principal liabilities in respect to the fire safety remediation are well known and are controlled. So put simply, we are a growing business and we're capable of delivering even stronger returns to shareholders in the years to come. So thank you very much for listening. And with that, I'm going to suggest that we move to Q&A.
That's great. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do so just by using the Q&A tab that's situated on the top right-hand corner of your screen. Just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboards. As you can see, we have received a number of questions throughout today's presentation, and at this point, Victoria, if I can hand over to you, that'd be great, and I'll pick up from you at the end.
Great, thank you. So the first question that's come through is, with an improved forward order book and pricing, could you accelerate your medium-term margin and returns targets?
Well, I think the improved forward order book gives us confidence, certainly for our growth targets for 2025, and it gives us confidence that we're doing the right things for those medium-term targets. I think those medium-term targets are ambitious but achievable. I think let's get a little closer to them before we start accelerating them all further. But certainly, what we think is that we've got the right building blocks in place to drive those medium-term targets, as say, assuming a stable macroeconomic background, which, and I think the pent-up demand for new housing is there and is strong. So that stable background gives us a real opportunity to deliver those targets.
And I think linked to that, so the strong start that we've had in 2025, how much of that do you think is linked to the upcoming stamp duty changes? How much is coming to Q1 that would normally have been delivered in Q2 onwards?
Yeah, the stamp duty changes, I read a lot about this in the press. It's relatively little impact for Persimmon for I think two reasons. Firstly, we don't have a huge amount of finished stock. The way we control our WIP through the year, we don't come into kind of January, February with lots of finished stock, more than we would have otherwise been budgeting for. So if you like, at the moment where they announced the change of stamp duty, if you like, our Q1 production was already pretty well set in train. And secondly, because of our price point, our customers are relatively less affected. So a first-time buyer buying a £300,000 house is no change to their stamp duty. So because of our price points, relatively smaller impact for us. I think the impact you read about a lot in the press at the moment from solicitors and estate agents and so on is probably driven more by the second-hand market rather than by new build.
Okay, thank you. And then moving on to sort of land buying. So there are a couple of linked questions here. The first one is, what is your land buying strategy for 2025? Will you remain selective, or is there an opportunity for sort of faster expansion? And then sort of following on to that, the second one is, what impact will you then see from the land investment you've already made over the last 3 years? What impact will the land have on cash flow and dividends for both 2025 and beyond?
Okay, fine. So our strategy is to continue to invest in land. So we need to invest in land because that's our, if I like, our raw material to grow the business. So we have invested heavily in the last 3 years when the market's been softer, and we'll continue to invest in land because whilst the land market is, it's still relatively orderly, that's the right thing for us to do to grow the business. And we can still buy land at the appropriate hurdle rates. We can still buy land with deferred payment terms and the right payment terms to meet our requirements. So we are still active in the land market. There's still lots of good opportunities coming to us. And I think with the government's ambitions and with the planning reforms, that helps and is a tailwind into the land market. So I think clearly as we go forward through the plan, the amount of net investment into land in the medium term would perhaps start to stabilise, and that then generates more free cash, and that gives us opportunity around shareholder returns, of course. But I think it was the right thing for the business to invest in land at the trough of the market, because that's what's allowed us to grow our outlets in 2024 and to return to growth so quickly after the difficult period at the back end of 2022.
And sorry, just on that.
Oh, sorry. Vicky, sorry, I lost you.
Yeah, it went on mine as well. Sorry. So just in terms of the house building, pro-house building stance of the government, how much could that sort of help with accelerating? And is there anything else that the government should be doing that you'd be looking for?
Yeah, so look, we are encouraged. I think they're doing the right thing on the planning front. I mean, let's be clear, that's not going to affect my delivery in 2025 or probably even into 26, because clearly there's a gestation period from a change of planning rules to getting something designed through planning, constructed and on site. But I think in the fullness of time, it's very, very helpful. I think they've gone, I think they've really grasp the nettle, if you like, of some of the challenges in the planning system, and they've really looked to try to address those. So we are very encouraged by that. And as I say, what we've in the very short term, what we've done is we've gone through our strategic land bank. We've looked to see where there are sites in there that we can potentially accelerate into the shorter term land bank because of the fact that they may now get planning allocations earlier than they would otherwise have done. So we're very encouraged by what they've done on planning. Clearly, they haven't at the moment talked about anything on the demand side. This is the HBF have a statistic that this is the first time in 60 years that there's been no support for first-time buyers on the demand side, and so I think the affordability, particularly for first-time buyers, is still that accessing the mortgage market and being able to get hold of a mortgage to be able to move into the housing market. That is perhaps the challenge which we haven't seen addressed yet, but certainly what they've done on the planning side, I think we're very encouraged by.
Thanks. And just sort of looking at sort of the ability of the industry to be able to deliver sort of an uplift in housing, we've sort of heard a lot about an industry-wide skill shortage. Are you seeing any of that at the moment? And what strategies is Persimmon putting in place to secure sufficient labour to meet build targets in 2025 and beyond?
Yeah, so that's not a issue as of today, but then the sector is the volumes at the moment are relatively lower, of course, and so I think as the sector looks to increase delivery, and we've only as a country delivered 300,000 houses on occasion, so the skills that will create some skills challenges, I've no doubt. It's why we need to continue to invest in apprentices and trainees and early careers and bring people into the sector. But it's also, from a Persimmon perspective, why the investment in vertical integration in our timber frame factories, in the facade product that I talked about, are so important. Because if we can deliver more volume with the same number of people, then that clearly is a very good way to address skill shortages as the sector grows. And so, moving to a off-site manufacture of timber frame panels to on-site assembly of those panels needs different skill sets, needs probably fewer people. And certainly, if we then bring the facade product in rather than having brick skins, then again, that takes away another pinch point from the skill set. So I think, of course, investing in people, investing in early careers is very important, but as is the innovation, vertical integration, modern methods of construction. I think it's in combination. Those two things is how, as a sector, we address the skill shortages in order to deliver those higher volumes.
And I think just linked to that, there's another question sort of around the investment in automation and the new timber frame factory. I suppose, can you just expand a little bit more on, how quickly you'd expect to sort of get that up and running, what sort of the capacity of the factory could be, and how much efficiency and cost savings do you think that will bring sort of over the next 3 years, like longer term?
Yeah, so sure. So the timber frame factory at the moment, our existing factory, we've got one of our lines out of action. Whilst we're replacing it, we're upgrading it, putting in an automated line. That will increase the capacity of the existing factory. So last year we probably delivered something like 25-30% of our product through timber frame. We would like that to grow up towards 50%. So increasing the quality and the efficiency and the capacity of our existing factory is important. That new line will be in production in the middle of this year, so that's very, very close. We have got permission for a second factory that will increase, probably double our capacity overall. We haven't started construction of that yet. We'll probably start that work later on this year in terms of the early groundworks and so on. So that will come online in, I guess, a couple of 3 years, maybe a couple of years' time. But overall, it's important that we do two things. One is that we invest in that quality and the capacity within the factory. And secondly, that we invest in the skill set of our teams and our supply chain to be able to use the timber frame product. So at the moment, timber frame is quite a regionalised product. So Scotland is very familiar, southwest of England is very familiar, but then other parts of England, timber frame is not something which is has been used extensively. So again, upskilling our supply chain in line with us increasing our capacity is what we're looking to do there. And as I say, if I was to build a timber frame house with my own bricks as the brick skin and my own roof tiles on top, including the shorter construction period, that probably saves me £5,500 per plot. If I was to then wrap it with the facade product we're talking about instead, given the speed of delivery, that saving could be nearer £10,000. So significant cost savings as well as the capacity that it gives us. So it's a really important part of the strategy.
Thank you. And just sort of moving on to capital allocation a bit, there's a question here to say, what is the company's view on share buyback programs? Do you agree that the market doesn't really appreciate them and shareholder returns are better by increasing dividends?
Yeah, so what we've said on capital allocation is, in the first instance, we want to make sure that we have a sustainable dividend through the cycle. So that's why this year we brought our dividend cover up a little to 1.54 times. And as we go forwards, then we'll be able to grow our dividends as well. I think in terms of then, if there is excess capital beyond that, whether there's additional dividends, whether there's capital share buybacks, that's something that we would look at the time based on market conditions, and so on. So, I guess I'm open-minded, but in the first instance, I'd expect to see probably the dividends increasing before moving into share buybacks.
Thank you, Andrew. A slightly different sort of topic, but looking at the net zero sort of moving targets, how disruptive are the various changes for Persimmon, and to what extent are we looking to build houses with solar and heat pump systems versus more traditional systems? So perhaps just talk a little bit about upcoming regulation.
Yeah, so there's various regulatory changes. So the Part L of the building regulations brought in requirements for solar panels, for the PV panels on roofs, electric car chargers and so on. The future home standards, and there's a little bit of uncertainty about exactly when that will be fully applicable. You will replace gas boilers with air source heat pumps, for example. So there is a kind of regulatory move towards lower carbon houses, once the houses are there and in operation. So, the challenge, I think, for any company with regulatory change is when that regulatory change happens with little notice. So, what we would look to do is those regulatory changes do add cost to the building of houses. So it is more expensive to put PV panels on the roofs than to not do. It is more expensive to put in air source heat pumps than gas boilers. So we would look to build all of that cost base into the cost base as we acquire land as we go forwards. The transitionary risk is always on the land I've already acquired. If the regulations change, then the question is, well, how do I recover that cost? Because it's not something which I think our customers are seeing the value of in order to pay particularly much extra for at the moment. So that's why there's, on that margin slide I showed, I said it won't be a straight line. There'll be some bumps in the road because as regulatory change comes in, before you can factor that into the land acquisition process, then that is a cost to the business. So for my mind, I think having enough of a run-in, enough line of sight into the regulatory changes is very important. This is an industry which clearly works in, we buy land, we need to have a long enough line of sight in order to factor the costs into the work that we're doing.
Thank you. There is just one final question sort of on the list at the moment, and that's, a thank you for presenting on Investor Meet, but when might Persimmon make research available for private investors?
So this is something we talk about from time to time, so we keep under review. So what I like to do is to look across the pieces to our investor relations activities. So this is the first time, for example, that we've presented on Investor Meet Company. I think it's a platform which reaches a wider audience and a different audience to other investor relations opportunities. And I think the paid for research kind of falls into that same bucket. So look, we keep all of these things under review, and we just keep trying to make sure that we've got a balanced approach across the whole IR strategy.
Thank you. I think, Andrew, I think that's all the questions that we've got at the moment, if you want to make some closing remarks. Okay,
well, thank you all for the questions and for joining the call today. As I said, 2024, we're very pleased with our performance. That was, particularly that was a performance delivered under our own steam, not because of a really strong market backdrop. And you can see hopefully from the strategy and the elements of the strategy I've set out on today's presentation that we are well placed to grow and to continue our growth into 2025 and beyond. So thank you all for joining the call.
Andrew, Victoria, thank you very much for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of PERSIMMON PLC, we'd like to thank you for attending today's presentation, and good morning to you all.